Ever notice how a breaking news headline can send your trading chart into chaos? One moment your trade follows the technicals, the next a sudden spike or plunge wipes out your position or hands you a windfall. This isn't random. The Forex market is tightly linked to global news. Political announcements, diplomatic tensions, and international incidents all send shockwaves through currencies, often before any other market reacts. Ignoring headlines is like sailing without a weather forecast. You might be fine, but eventually, you'll get caught in a storm. The real drivers of currency moves aren't just in the charts, they're in the world's daily dramas. A surprise election or sudden conflict can change a currency's fate overnight. As a trader, you need to read both charts and the world. Political stability fuels investor confidence. Instability sparks capital flight, weakening a currency. The price swings you see are the collective reactions of millions to real-world events. To succeed, you must be both a technical analyst and a global news junkie. Staying informed gives you an edge. You'll spot volatility, manage risk, and find opportunities others miss. The news ticker isn't just background noise, it's a vital trading tool. The four horsemen of Forex volatility. So what exactly is this powerful force that can shake up your trades? In finance, we call it geopolitical risk, the uncertainty from global political events that can shake markets and currencies. For Forex traders, it's a primary source of volatility. There are four main types: war, elections, sanctions, and trade wars, and general political instability. War is the most dramatic. It diverts resources, disrupts trade, and scares off investors, causing currencies to crash. Elections and political instability create uncertainty. Markets swing as traders bet on new policies and leadership. Sanctions and trade wars are economic weapons. They cut countries off from global trade, crushing currency demand. General instability, protests, scandals, sudden resignations spooks investors and weakens currencies. Each horseman brings its own storm, but all can trigger massive moves in Forex. Understanding these risks is the first step to navigating them. As a trader, you must watch for these events and anticipate their impact. The market's reaction is often swift and severe. When geopolitical stress hits, traders rush to safety, selling risky currencies and buying those seen as stable. These are called safe haven currencies. The US dollar is the king of safe havens thanks to America's massive liquid markets and the global demand for US Treasury bonds. Even if the US is involved in the crisis, the dollar's reserve status makes it the world's go-to currency in a storm. The Japanese yen is another safe haven. Japan's political stability and status as the world's largest creditor mean money flows back home during crises, strengthening the yen. The Swiss franc rounds out the trio. Switzerland's neutrality, strong banking, and low debt make it a trusted refuge. When crisis hits, watch these three: USD, JPY, CHF. The flight to safety is one of the most reliable patterns in geopolitically driven markets. As a trader, you should immediately consider how breaking news will affect these currencies. Safe havens offer shelter and opportunity when the world gets stormy. Understanding this flow is crucial for capitalizing on global uncertainty. Don't ignore the safe haven effect. It's a core part of Forex strategy. In times of turmoil, follow the money to safety. War is the ultimate market disruptor, creating instant uncertainty and economic chaos. Countries at war see their currencies collapse as resources shift to conflict, trade halts, and investors flee. The Russia-Ukraine conflict in 2022 is a textbook case. The ruble and hryvnia both plummeted, and capital controls couldn't stop the slide. But the impact didn't stop there. Europe's reliance on Russian energy meant the euro also weakened, as fears of recession and inflation grew. Meanwhile, safe haven currencies like the US dollar surged as global investors sought shelter. The USD index hit multi-decade highs, showing how capital flees uncertainty. This pattern is clear: currencies of nations in or near conflict weaken, while safe havens strengthen. As a trader, spotting this flow is essential for protecting your capital and finding opportunity. War destroys economic value and confidence. Watch for the ripple effects. Even regional conflicts can shake global markets. Always consider both direct and indirect exposure when trading during conflict. In war, the first casualty is often the currency. Elections are frequent sources of Forex volatility. A major vote can change a country's economic direction overnight, creating intense speculation and wild currency swings. The 2016 Brexit referendum is a prime example. The pound soared and crashed with every poll, then collapsed when the Leave camp won. After elections, markets scrutinize new leaders' policies and appointments, especially in key economic roles. Promises of tax cuts or spending can boost a currency if seen as pro-growth, or hurt it if they spark inflation fears. Political instability, like a contested result, creates uncertainty, which investors hate. They'll sell the currency and wait for clarity. For traders, the real action often comes after the votes are counted, as markets digest the new reality. Elections aren't over when polls close. The aftermath can be just as volatile. Watch for policy signals and market sentiment shifts. Stay nimble and ready for surprises. In politics, nothing is certain except volatility. Not all battles are fought with weapons. Sanctions and tariffs are powerful economic tools. Sanctions cut countries off from global finance and trade, crushing demand for their currency and causing sharp depreciation. The Russian ruble and Iranian rial both collapsed under heavy sanctions. Trade wars, like the US-China conflict, disrupt supply chains and slow growth for everyone involved. Tariffs make exports more expensive, reducing demand for the targeted country's currency. The Chinese yuan fell as tariffs hit and capital flowed out amid uncertainty. Even the US dollar, while initially strong, faced risks as American exporters suffered. Trade wars are lose-lose, casting a shadow over global growth and currencies. For traders, these events create volatility and opportunity, but also risk. Always assess which currencies are most exposed to sanctions or tariffs. Stay alert for sudden policy changes and retaliations. Economic warfare can move markets as much as real conflict. Trading during geopolitical turmoil is like steering through a hurricane, fast, unpredictable, and risky. But with the right approach, you can survive and even thrive. First, use the economic calendar. Major events, elections, policy meetings are often scheduled. Check it daily to anticipate volatility and adjust your positions. Second, focus on major currency pairs and safe havens. Liquidity dries up in minor pairs during crises, but USD JPY and CHF remain reliable. The flight to safety theme gives you a clear trading direction. Third, control your emotions. Breaking news is designed to shock. Don't jump in or panic sell on headlines. Wait for the initial chaos to settle, then look for clear trends before trading. Stick to your trading plan and risk management rules. Discipline is your best asset. Let the market digest the news before you act. By understanding the news and controlling your reactions, you'll stay ahead and stay in the game. Geopolitical events are inevitable, but with preparation, you can turn volatility into opportunity. Stay informed, stay calm, and trade smart. In chaos, discipline wins.